Well, happy holidays, everyone. This is Al Dominic, the CEO of Bank Director, and I'm holding it down in our corporate headquarters in Nashville, Tennessee. The elves are fast at work getting ready for Acquire Be Acquired in January. We're just excited beyond belief that we're going to be able to get back out to the Arizona desert and welcome just an incredible group of men and women from all over the U.S. To the JW Marriott. So this is our Ask the Expert, almost a prequel, if you will, to the event itself. And we thought this would be a real nice opportunity for us to start to put out some of the themes and questions that we know will be addressed when we're together in Arizona. So the webinar today, it's brought to you by a handful of companies. I want to thank them, Benning and Scattergood, Performance Trust, and Stevens. All three helped to make this possible. Before I introduce I'll call them constituents from across the country on this webinar, I just want to remind folks of some housekeeping details. First, and maybe most important, is that you've all joined this in listen-only mode. So that means that you're automatically muted. So as much as you want to yell at me and say you disagree with something, you're going to have to put it into a chat so that I can try to tee that up as a question or some type of statement for the folks that are on here. For a better viewing experience, we would recommend you click on the slide bar at the bottom of your screen because this puts presenters into full screen mode. I'm teasing a little bit about yelling at me, but we do encourage questions to be raised, and what will happen is you can use the Q&A button found on the right side of your screen to put something in front of us. And I'll do my best as the moderator of this webinar to put it out as quickly and fairly as I can. Now, there's no need to take notes. I know some of you, have your pen and paper at the ready, but this is going to be a webinar that we share within 24 hours. That'll come out on the bankdirector.com site. Anyone who's registered will get an email letting you know that this is going on. Now, knock on wood, we're a year into doing these. We have not had really any technical challenges. If something does come up, we'll do our best to take care of it. All I'd say is, hit the Q&A button or hit one of the little icons on the right-hand side, and our team will do our best to respond. So easy housekeeping, less than 2 minutes. Let's get into the meat of today's webinar. And by doing that, I'm going to ask Charlie Crowley to first start by pulling his camera on, saying hello to everyone.
Hi, Al. Hi, everybody.
Charlie, it's good to have you with us today. Thanks for taking a little bit of time. Charlie, tell me where you're coming in from.
I'm in the Cleveland office of Benning and Scattergood.
Very nice. Well, like seeing at least some sunlight behind your back. Jim Hemmer, you're Managing Director of Depositories at Stevens. I'm going to ask you to come in next, please.
Afternoon, Al.
And Jim, we've heard one from Cleveland. I'm in Tennessee. What about you? Where are you today?
I'm in Chicago.
Oh, okay. So we've kind of got the Midwestern part of the country being represented. So last, certainly not least, Gary McNorrell, Managing Director and Head of the Southeast Region at Performance Trust. So Gary, when you click on, I'll ask you the same question I've asked the other two gents, where you're saying hello from.
Good afternoon. Can you hear me out?
Got you, loud and clear.
Great. Coming from Charlotte, North Carolina office of Performance Trust.
Very nice. Well, appreciate the three of you taking a little bit of time with us today. We, as I mentioned, are getting really excited to get out to Arizona for Acquire Be Acquired. A lot of the thoughts and issues that we're hearing from bank management and boards of directors really comes into the M&A space and what's going on and some of the questions that need to be asked maybe in advance of the calendar flipping from this year to next. So I just wanted to spend maybe 45, 50 minutes with you guys getting your opinions on a handful of topics. I'm going to just jump right in. Again, as you're listening to this at home, you have a question, feel free to ping us and we'll do our best to throw it to Jim, Charlie, or Gary. But maybe I can start with you, Charlie, about some of the earnings challenges that you see banks potentially facing over the next 12 to 18 months.
Sure. Yeah, well, it's obviously been a crazy couple of years in the economy with the pandemic and so forth. And so I think where we are now, and I would assume that Jim and Gary are hearing the same things, right? People a year ago, early in the pandemic, maybe in hindsight, over-reserved, with some fears of what might happen to the loan portfolio. That set them up to where this year the provisions have been lighter. In some cases, there have been reserve recaptures and so forth. So if we get back to a quote more normal environment last year with a little bit of loan growth and more normal provisioning. On a year-to-year comparison basis, compared to this year, that obviously creates a little bit of a headwind. Another factor that we're all hearing is, many of the community banks really did a great job on PPP lending and helping borrowers in their communities. That has given an influx of added income this year, which won't be repeated next year. And then everybody's been, kind of facing margin compression with, the date of the yield curve and so forth. So hopefully that'll pick up a little bit next year. But right now, if you look at a lot of the analyst estimates for, banks that have research coverage, the expectations are for many banks that earnings per share will be down next year compared to this year. So that does create some challenges.
Yeah, and as you were talking, I just made a note to ask Santa if you could help me define what normal is going to look like in the years to come. Because everyone talks about it, but man alive, I think that's one of the big topics du jour is what does normal look like for us?
Right.
Charlie, as you're talking, I want to flip this over to Gary and talk about some of the larger challenges facing traditional depository banks really in 2022 as you see it.
Yeah, I mean, a couple of things I would add potentially are to Charlie for regardless of the size of the bank is also the mortgage business, right? I think the mortgage business it's why you have it, right? It can be counter-cyclical. I think so. I think we all believe that the mortgage side is going to be flat at best, maybe lower as well for next year. So that's another item. And then certainly excess liquidity. There's so much money in the system and on these banks' balance sheets. We looked at pre-pandemic, the industry as a whole had loan to deposit ratios around, I think, just over 70%. We're now closer to 60%. So it was just quick math we did. What would it take to get back to that? And it was almost $4 trillion. So I think you have that excess liquidity on the bank's balance sheets. We can talk later about how are some banks deploying that. But I think you also have excess liquidity on your clients' balance sheets. There may be less lending. And then also private investors. I would say, we see, and I'm sure Jim and Charlie probably see this as well. I bet you see it out in Nashville. If there's a solid commercial real estate project in a high growth market, it's not just banks you're competing against. You're also competing against private equity and sometimes losing to them. So I think that's a couple of other things I would add, that are a challenge going forward outside the standard sort of uncertainty of the economy, both macro and locally and domestically as well.
Yeah, I think everything you're saying is spot on. Jim, I want to give you a chance just to balance out what Gary and Charlie have already shared. Do you have any thoughts?
Yeah, so I think when we look at what's going on right now, this year we saw a lot of concern early in the year that there were what 2022 and 2023 were going to look like in terms of the earnings outlook for banks. There's a lot of positives going on in the industry with the profitability of the group, the lack of credit issues, and basically large capital levels that they could put to use. But the backdrop is in 2022 where was there going to be any loan growth, particularly commercial loan growth, and when you look at the yield curve, how much were net interest margins going to be eaten into? This last quarter, publicly traded banks released pretty good earnings reports as a whole. We saw loan growth better than expected kind of across the group, particularly in the commercial space. Still had a lot of positives from PPP and mortgage, as Charlie and Gary mentioned, but underlying that, I think there were some decent trends. And then, I've been tracking, and as I'm sure everybody has been, more sentiment this quarter, and we're seeing more companies coming out with a more positive view on the loan growth outlook for 2022 and hopefully 23. And then you were seeing the forward rate curve looking at 5 hikes in 2 years. I think our research analysts just bumped our group up to 2 next year and 1 in 23. So, not a real positive tone, but at least a positive trend from what was pretty negative sentiment early on.
Yeah. Well, so I made a note. You mentioned capital levels. It just got me thinking about some of the excess liquidity that's in the system. And and Charlie, I'm going to ask this to you. Do you see how, in some cases, stretching capital levels is why we're seeing so much issuance of subordinated debt at the moment?
Yeah, so as Jim mentioned, I mean, a lot of banks have been very profitable, are certainly very strongly capitalized, and the industry as a whole continues to be very strongly capitalized. But on a bank by bank basis, there certainly are some banks that have been stretched with the excess liquidity from the economy coming out of their balance sheet. There are a lot of people that, a lot got their PPP money or their stimulus checks for their household and just left it sitting in the bank, and that's why Gary mentioned the loan to deposit ratio is coming down. In some cases, that stretched the capital levels a little bit, some of the banks, and that has caused some of them to look at issuing subordinated debt, which can be helpful, especially for a small bank holding company downstream the money to the bank and help the capital levels at the bank, and just historically cheap levels for unrated issuers. So it's a lot of issuers are taking advantage of it. And on the other side, a lot of community banks and banks of all sizes that are sitting on excess liquidity on their own balance sheet are viewing these as pretty attractive risk-adjusted yields in this environment, kind of a hybrid between investments and loans, and seems to be fitting. So it's been pretty active last year for that, for all of us.
Well, again, I want to respect everyone's time today. So much of what we're going to be looking at over a 2.5-day period are some of these challenges and forces that are impacting the industry. But again, the Ask the Expert series that we have is really designed to tee up a few quick hitters. And so as Charlie's talking, I want to ask, let me ask this to Jim about some of the key drivers for bank M&A today and going forward into the new year. Because everything that you guys are talking about is so important. But if you're thinking about doing a deal, help put that into context.
Yeah, well, I would say that the challenging outlook for loan growth and falling margins are going to encourage banks to pursue M&A to drive earnings and efficiency. Most banks, have accelerated their technology plans dramatically, coming out of COVID, the pandemic, and I think had been very focused on internal efficiencies. So there isn't a lot more to wring out there. But in the context of an M&A deal where you have overlapping branches and you have, systems that are redundant, you definitely have an opportunity to drive earnings and efficiency with those transactions. We're also seeing a lot of banks, looking at business line acquisitions or trying to buy banks that have loan niches to really drive what looks to be, a slow loan growth environment going forward. So, overall in 2021, we saw activity levels that were up significantly, but that doesn't say anything because there was nothing going on in 2020. Basically the M&A market shut down. I think the outsized amount of deals this year have been driven by a number of deals that were either in the queue or, were moving down the road and then they got tabled because of COVID. And then other deals that popped up, in the course of this year because management teams were looking at the issues that, they could be faced with going forward. So that's what I really think is the key drivers here. The other thing I would say that would be an interesting driver is, as we sit here today, buyers' deal metrics are probably as good as they've ever been. So on average, we track the last 25 deals with over 50 million in deal value, where the buyer is a publicly traded company. And as we sit here today, the average, earn back on those deals is just over two years. So really attractive there. And the median earnings accretion is close to 10% when you take fully phased in cost savings. So, when you're faced at a slow growth environment, doing a deal that has those metrics, I think, is going to bring people to the table if they can get transactions like that done.
When you were talking, you mentioned earnings, and it popped into my head that investors are expecting an earnings gap in 2022. So Gary, help me think about what banks can do to avoid a drop in their earnings.
Yeah, we've already identified a couple things, both Charlie did and Jim, that are headwinds and things that are going away. A lot of it driven by government support, either PPP or mortgage being sort of a separate category, and then having excess liquidity. So I think, what we're seeing, some of the clients that I speak with is one is kind of traditional, customer penetration. Are we getting a larger share of our current customers' wallet? And I think part of that is, through PPP, a lot of the participants gain market share and customers. And are we actually getting the share of the wallet of those new customers? And I think it's also, as Jim said, I think it's diversifying your income streams as well. What are you doing besides traditional yield business? I mean, whether it's the SBA following PPP, is it wealth or insurance? Certainly fintech partnerships are hot right now, but just I think continuing, as Jim highlighted, you had, I think, 2 to 5 year plans on technology and online banking and improving all that became 6 to 9 month or 3 month plans. So I think continuing to focus on broadening your income sources and making sure you're penetrating. That can be through, again, just expanding to those areas, or it can be M&A. And M&A can be for bank, non-bank. It can be team lift outs as well, but just trying to consolidate your markets and go to new growth markets. And then lastly, I think a lot of folks have looked at cost saves, but I think the technology spend can help you on the efficiencies, but also branch network is obviously one that's been around for a long time, but you've seen a lot of announcements recently, certainly the bigger banks, but Atlantic Union, I think, recently said they're going down another 16 branches. Ocean First in their recent acquisition, which is driving some of it. They're going to try and reduce their footprint by 30%. So I think looking for cost saves is one, and then continuing to diversify your income stream.
Yeah, COVID certainly has been an accelerant for so many different strategic decisions that I know has been discussed for years, but all of a sudden, we're starting to see both the good and the bad of what had to be done. I'm thinking about the creation of value, franchise value in particular, but to get there, I'm thinking about valuations. And so as we're talking about how banks are starting to reposition themselves and to think about where they want to go and what they want to be known for, I'm trying to think about the industry and how it's seen. Charlie, I don't know if you could talk to us a little bit about some of the Russell community banks and the valuation disparity that might exist between those traded in the index and those that aren't. But is that the type of thing that's going to drive, deal activity? And, how do banks on both sides of that ledger think about what's coming?
Yeah, it's a good point, Al. We think that is certainly a topic of discussion. And for those on the webinar who aren't familiar, the Russell 3000 index is ranked by market cap. It's a very simple screen. And that cutoff went from 95 million in market cap the year before to, I think it was 257 million last year. And a lot of that was driven, you've all heard about these SPACs that have been formed and that have acquired other companies. And they're in some cases just crowding out, real companies like some of the banks we deal with. So I think there were roughly 80 banks that were kicked out of the Russell last year, and not because of bad performance from those banks. It's just, the market cap went up so much. So they're at a little bit of an awkward position. They're at a disadvantage from a pricing standpoint if they're competing in an M&A contest against somebody who is in the Russell. I think if you look, we were looking at the S&P index values yesterday for actively traded banks over 10 billion. The median trading multiples, give or take 170% of book. For 1 to 10 billion banks, it's more like 127% of book, tangible book. And for the smaller under $1 billion banks, it's give or take book. So there's a built-in kind of pricing advantage for the larger banks that could give them an opportunity to put a bigger potential multiple on the table for a sub-Russell, community bank, and it also gives them a bidding advantage. So that doesn't mean if you're, in that sub-Russell category that you need to sell or should sell, but it's another element. We think a lot of those banks should be aggressively buying back their stock right now because, by historical levels, they're very cheap. And that's nothing for the earnings gap that Gary was talking about. If you can buy back shares at an attractive value, that's going to help your earnings per share and your ROE, which makes sense too. But that's just another thing that we're kind of seeing, and I'm sure Jim and Gary are as well, that's kind of rolling through the market when you think of some of the what ifs out there over the next few years.
Yeah, so Gary, let me ask you about some of the valuations for bank stocks that seem somewhat stagnant. What Charlie just said, I think, is important. Are there banks that are bucking the trend and maintaining attractive multiples that would give them opportunities to do something compelling if they so desire?
Yeah, there certainly are. And this is one thing that I know Jim and Charlie, in the fall and later in the year, you're doing these strategic planning sessions. And one thing we did, which is a really simple exercise, we just said, all right, what banks are out there that are trading at over 2 times book, and let's say 20 billion in assets and below. So it's not just the big guys. And so again, I can send this slide or anybody could run this. And we just said, who is it? And it was 34 banks, and their median total assets was around 6 billion. So it wasn't necessarily 15 or 20 billion. And again, one of the things that jumped out was the percentage of operating revenue that was non-interest income generated was 21%. Their ROAs were 1.6 and ROEs were around 13%. And I'll say their net interest margins were 3.3. So they were feeling the crunch just like everybody else. But I think the diversity of income is one thing. And then certainly the efficiency ratio is around 49%, around 50%. And so a couple of themes, and again, this won't be a surprise to Jim or you, Al, or Charlie, but there were about 6 things. It was income diversity, niche lending, where they specialize in how, in their lending, being in high growth markets, fintech partnerships. If you're a fintech savvy bank, some of those guys were getting recognized as well, active acquirers, and certainly scale. And I'd be interested in, if Jim and Charlie are seeing this, but I feel like scale, traditional scale, it seems like it has moved a little bit if you're talking about premiums based simply on scale. Is it no longer the $2 to $3 billion bank? Does it need to be that 5 to 10? And that doesn't mean you have to have that survive, but what are investors seeing? So if we look at those banks, you certainly have the outliers. You have the Live Oak banks. Everybody can't be Live Oak, right, and be an $8 billion bank with one location, your top SBA lender. But they have the niche lending. They have certainly the fintech. We can go on all the fintech things they're doing, moving their core to the cloud. Or if you say, hey, we got a Home Bank Shares, which is a large acquirer in their big markets. But, a couple I was just going to point out real quickly. There's Coastal Financial in Everett, Washington. They're $2.5 billion. So they're not huge. But, they have around, 16% of their revenue comes from non-interest income, but C&I is 41%. So they have a good bank that's over 1% ROA. But they also have this division that's, it's a fintech division and banking as a service. They have 21 fintech partners. So they're really moving in that direction. But you don't have to be fintech. You can be, Charlie, I know as well, German American Bank. They're in Jasper, Indiana. They're $5.5 billion. Maybe similar stockyards in that they have a large AUM, $2.5 billion assets under management. They have $70 million in annual insurance premiums coming in, so that helps. They're also an active acquirer of banks and insurance agencies. So, I'll leave it at that, but I think it's income diversity, niche lending, growth markets, fintech, active acquirer, scale. You don't have to do all those things, but if you pull that list, these banks are not just relying on spread income, and they're pretty active in a lot of these areas.
Yeah, I love the list, and I want to ask Jim and Charlie if either of you want to add to it. Is there anything that Gary said that you said, yep, and I'd build on it, or actually I might take it in a different direction? Are you both feeling like he hit those points?
Well, I think he did a nice job there, and we looked at the same stuff, and it's definitely high performance institutions is where you get the outsized valuation, and a lot of people are getting there different ways. I would take it a little bit of a different direction because I think broadly the banking industry is suffering from pretty low multiples relative to history. So, I'm a Midwest guy. We looked at publicly traded banks between 1 and 2 billion in assets, and they were trading at a median price to tangible book of 115. And about 9 times trailing earnings. Now, granted, there's PPP in mortgage in there, but those are still low multiples for that size range. Meanwhile, that group has no asset quality issues. They have high capital levels. They're performing well on ROA and ROE basis. So we've been wrestling with is what's the industry facing? Well, they're facing a serious headwind from fund flows. So in late 2018, we had a lot of funds, generalist funds, that were leaving the industry because banking couldn't get any better. And that's been progressively happening. So just those generalist funds coming out of the industry has hurt valuations over time. And then the pandemic just completely exacerbated that. So you had all those funds flying into tech and growth areas, and the uncertainty around credit in the banking industry just took that whole group out. We're starting to see them come back. But one of the other things that was really important, I think, to our industry and to the run-of-the-mill bank, community bank, regional bank, is the bank-focused investors out there. So there's a group of those investors that have been very important to the industry. And in late 2018, the top 10 of those money managers had assets under management in the industry of close to 10 billion. 2 months after the pandemic hit, those funds were at about 5 billion. The massive downdraft in the bank stocks and then also fund redemptions were huge. Some of those funds went out of business. Many of them have less money than they had, significantly less money than they had to put to work. And they're under about 6 billion invested today. And some of those funds too are focusing more on raising money towards fintech and fintech investments. So, those are meaningful headwinds for the group. And, I think those are people that dig in and say, this is fundamentally a strong company. I'm going to buy them. And we don't have as much support there. And the other thing I would add to what Charlie was saying, our research team did a review of the Russell 2000 for next year, and they're judging that that's going to be in the 350 million range, so going up again. So just more banks that would historically been in very comfortably getting bumped out.
Yeah. Charlie, any thoughts on this particular topic?
No, I think the only thing is, again, the most strongly performing banks that Gary outlined, they are in the premium position, right? They can pick and choose, and they don't even have to use their full multiples in an acquisition. It doesn't necessarily mean that that's the right partner for somebody selling, right? There are opportunities. Some of these undervalued stocks, if you're putting two companies together, you could swap into another stock that is also undervalued and ride up with them over time too. But I agree, with what Jim's saying. Eventually you need investors to come in and get that there's this gap. We're talking about an earnings gap with banks, this valuation gap, as Jim mentioned, between these well-run, profitable banks, trade at 10 or 12 times earnings, and you look at the S&P and Dow multiples are 20 plus, and so perhaps in a higher interest rate environment, some of the tech stocks lose their steam, and in a relative sense, bank stocks do a little bit better.
Yeah, it seems like, this year, the first 9 months obviously saw a ton of activity, but the deals, when they were announced, they weren't always favorably received. And so, I'm hearing what you guys are saying as we go into a more challenging period. From an investor standpoint, if they're skeptical about these combinations, should we be thinking that there's going to be a decrease in like the MOEs that have been done? Do you see that potentially picking back up in some ways? That is a complex transaction to structure, but it certainly seemed pre-pandemic like that was where some of these bigger discussions, centered around. You had the internal, like who's driving, who's riding, discussions, but you saw it obviously with Truist and the establishment from SunTrust and BB&T coming together, but so many different examples of, MOEs being struck. I'm curious as we're talking about activity and, kind of where we're heading. Charlie, do you think we're going to see more MOE type deals, or is it going to revert back to the straight I'm buying you or you're selling to me?
It's interesting. I mean, I'm sure Jim and Gary would agree that the percentage of MOEs that actually get struck compared to discussed is always pretty low, right? It's a lot of them stay on the drawing board. It seems like a good thing to do, but it really takes two boards and sets of management teams that have the ability to share and that sense of delayed gratification. So they can make sense. Some do make sense and work out very well. A lot could make sense and they just fall apart because of, a little bit valuation, a little bit probably more likely, some of the management slots. It's not just the board seats. And so I think what we tend to view, probably we'll see a little bit more of are, more in the strategic merger realm, not just, strict MOEs where one party knows, they're a little more equal than the other and therefore they're willing to pay a little bit of a premium for the slightly less equal party. And those can be very nice deals. And we probably will see some more of those.
Yeah, I mean, there's stuff that I find interesting. I look at Umpqua and Columbia, with their merger, even with Columbia being the larger of the two, keeping the Umpqua brand. There's different reasons I think that some of these deals have, potential impact in their communities. Gary, are there certain geographies or asset classes that are going to become more active than others when we're talking about an M&A outlook for the coming year?
I do think, I guess adding on to the MOE question is, you could potentially see it, I think in some of our markets, maybe in the Southeast, and maybe in a lot, we could use some more buyers, maybe in that, $2 billion to $5 billion to $6 billion range. I think valuations, expectations sometimes don't match up with who is actually interested in your bank, shall we say. So we did a couple in 2020. And again, MOE sometimes, I guess Charlie or Jim would say, can we translate that to low premium transaction? But again, it has to be two willing parties. We got two done. And those were basically scale plays, I think. The two we did was getting two smaller banks, sub $1 billion, up to, over $1 billion in assets. And I think it also added to, in the Virginia National transaction we did with the Fauquier Bank in Virginia, they both had 500 million in assets under management as well. So then you had a, $1.8 billion bank with $1 billion in assets under management. So that could potentially, I think a lack of buyers for some of these smaller banks and just trying to get scale could help drive M&A. I think the Midwest was one of the last 12 months, Charlie, I think was one, and Jim was one of the, I think they had something like 85 deals last 12 months. So I think that region's going to continue to see M&A, the Southeast as well. Georgia was very active, so was Florida, and Virginia was active also. And then, of course, Texas, California. I think you'll continue to see that as well. But if we have, back to Jim's point, and Charlie hit on this too, if we have the valuations gap, maybe that shrinks and maybe we see banks improve, all banks, not just the ones I highlighted, then I think that will drive M&A. Like we saw, quite frankly, at the end of, 2020, the vaccination gets announced, you see bank stocks recover, and immediately, as you pointed out, Al, the first sort of 3 months or so, we had a big uptick, and I think some of that was just pent-up demand. So I do think those banks that are kind of 10 billion and below, you're going to see a lot of activity there. Probably Southeast, Midwest, and Southwest will lead the way again.
Yeah. So Jim, let me ask you to do this for us. You talked to a number of bankers. What if you could kind of aggregate their thoughts and anonymize it so that you're not calling out one particular person's point of view? What are you hearing about their outlook for 2022?
Yeah, so I think we touched on this a little bit earlier, but the outlook that a lot of people have, I think, is more optimistic than they did, and it's really on the organic loan growth side. So I reiterating that point, I think, but it's very important, when you're facing net interest margins being compressed to the level they are, liquidity levels to where they are, deposits where they are, I think. Any loan growth is very important. We touched on, sub debt. We see more banks, buying other people's sub debt to get yield than we've seen in the past. So there's just a lot of need for yield out there. I think that, the sentiment too is, they may be able to hold their deposits down when rates rise a little bit, and that could be a benefit. On the flip side, though, I think a lot of banks have floors on their loans. So we're so far down now, hitting those floors may take some time. So I think there's still a remains to be seen about all this. And of course, the pandemic and where lockdowns and whatnot could take us is another uncertainty. And investors hate uncertainty. So all that uncertainty hurts the industry. I was going to piggyback on something that Gary said. Just the banking landscape itself is changing. He noted all the deals in the Midwest, and I mean that's changed the landscape in the Midwest in certain particular states pretty dramatically. And so then getting out on the road and visiting with people, their buyers list has changed, their targets list has changed. They're starting to think about deals that they might not have thought about in the past because they've got new challenges in that landscape. So, we've seen the number of banks in the country decline dramatically over the years. The number of small banks is declining, some because they're growing out of being a very small bank. But I think that, the days when everybody had a buyer at a big premium isn't necessarily the case. And so, one of the things that I think is important in the M&A world is fostering relationships and finding, where there are connections and opportunities that may work out sometime down in the road, whether it's an MOE, a sale, or an acquisition.
You talk about banks growing out of a certain size, and again, historically, if we walk this conversation back 5 years, we'd be talking about the sweet spot of banking being in that $1 to $10 billion asset class. They were well received from investors. They could do deals. They didn't have the same regulatory expectation or burden put on them. When people start talking about size and growth and things like that, I'm curious, Charlie, do you think that a bank has to be of a certain size to survive today?
Yeah, we really don't, Al. And I know we love your conference, and you get all kinds of great speakers and viewpoints, and there certainly there's a point of view. Obviously, there are benefits to scale. You look above certain sizes, banks are more profitable. But I guess we would say it's not necessarily acquire or be acquired. We think everybody has to grow or be acquired. They have to have a credible growth plan. But we know a number of community banks that the tiniest are going to have trouble keeping up with regulatory demands and cybersecurity and so forth, and eventually shareholder liquidity in a lot of cases. But there are plenty of community banks around the country that somehow figure it out, and they put up decent ROE levels year after year, pay a nice dividend, have a largely local, loyal retail shareholder base, and they can be around for a long time, if they choose to be. And some of them can grow even if they don't directly participate in M&A, just by picking up the pieces around them. You have some of these markets where the signs have changed 2 or 3 times, and just like we saw with the PPP, a lot of the well-positioned, nimble community banks were able to pick up some real customers, and they can get some growth even without having the currency or the capital to do acquisitions. So we don't think there's any magic number, but there does have to be kind of a sense of holding yourselves accountable for performance for your share.
I kind of think of it as like an asset size can be used as a crutch when things don't happen, because you can say, well, I can't because this is what I am.
Right.
It shouldn't be an excuse for lacking ambition. But at the same time, Gary, I want to ask you the same question, because you could look at some of these de novos that recently got chartered. They have a path that they have to hit a certain asset size to take their next step. Banks of all sizes, they're constantly looking at what's coming around the corner. The fintech valuations of some of these neobanks are just spectacularly large, and I'm not sure how to make sense of them. There's a lot going on. So same question to you. Does a bank have to be a certain size at this point in our economic history to survive?
No, I would agree with Charlie. From our perspective, it's not a certain size. It is probably overused term, right? Earning your independence, which is earning your profitability. But I do think these smaller banks can continue to become more efficient, right? And to use whether it's financial technology or putting into more money into technology for efficiencies, reducing branch footprint if needed. But I would say that I think one of the unique things about our economy is the small bank, right? It's a huge part of our local communities, small business, and it's really something I think differentiates us from other countries. And so it's extremely important. And yeah, you just maybe it takes a little bit more than it used to, pre-Great Recession, but you have to be able to, I think, diversify income again, I think is key, and be deep in your geographies. And I think Charlie hit the nail on the head that just being able to still be a survivor in a community bank, we see that in these local or smaller communities, or even in some of the urban, to have someone, that's a local bank. I mean, we had de novo here in Charlotte, and they just said, listen, we want to be the community bank, a private banking model, I would say more so. So they're looking more at the niche. They have a family office side to it as well. But it's not just, hey, we're going to raise $10 million at $10 a share and we're putting a bank in Atlanta, right? You have to be smarter about it if you're starting a de novo. For these small guys, it's all about, I think, the people and the penetration into the local community and your niche. And you can still certainly make a lot of money and be a contributor to the economy and to your stakeholders.
Yep. All right, so Jim, I'm not going to ask you to take the contrarian point of view, but I am going to ask your opinion on this one about size. And it may be that it's not about survival, but maybe it is about earning your independence like Gary just talked about. How do you kind of think about this size question when it's put to you?
Well, I'll start by, sort of echoing a little about what Gary was saying, and Charlie said beforehand. I mean, small community banks have a really important place in the economy, and they can be profitable entities that remain independent for a long time. One of the things that we see driving a lot of M&A, though, is those small institutions. They have shareholders that are getting older. They want liquidity. They have CEOs that are going to retire. They've been great stewards of the institution for a long time, and there isn't a logical heir apparent that's going to drive that profitability. So, there's no magic to size, but liquidity and succession are huge in terms of how you propel an organization forward. So that's also where size matters, right? As you evolve and you get bigger and eventually become a public company, continuing to grow through acquisition makes a lot of sense. And I think we've seen a lot of our clients having great success as they move through the, $1 to $2 to $8 billion size range. They're able to do a lot of acquisitions. They're able to invest in teams and build businesses. But then they come to the $10 billion mark, which is a big challenge, right? Do you want to cross it? There's an economic issue. How do you cross it? How do you cover the costs with Durbin? Almost all those companies are publicly traded companies that have investors to deal with on a quarterly basis. So, doing a larger transaction to get through that is important. So that's sort of the one area where, there's a challenge, and, bankers have to decide what they want to do there. And then once they break through that, there's another one down the road as well at a much larger size. But, I can't take the contrarian view, because Charlie and Gary are right. I mean, these institutions, that if they're growing, they can remain independent because they're building shareholder value.
Well, a few things, like when you talk about nearing that $10 billion mark, I've talked to some CEOs who have gone over it, and they said, we weren't just going to put our toe over, we were going to take like a big hurdle to give us some space. And it's a deliberate strategic decision that the board understands, gets behind, and you can see how certain deals were done with very deliberate pace and design. You guys are talking about some things that are really important, I think, for everyone who cares about the future of banking. How do you differentiate yourself? How do you diversify your earnings opportunities? Talked about Coastal. I've spent some time with Eric Sprink, getting to know him in the business. We actually have a session with Eric and Ira Robbins, who's the CEO of Valley, out at Acquire Be Acquired. I think Valley's done a great job of diversifying its business and bringing in some strong talent. But as we're talking about this, it's inevitable that we're going to talk fintech and what's going on. I've fielded questions in the past about banks buying fintechs and fintechs buying banks. Of note, there's really only 2 or 3 fintech transactions that people would talk about. What happened with Radius and Lending Club, smart deal for Lending Club and Radius. Then you look at SoFi out in California, and I think it's Golden Pacific, buying a charter on the cheap so that they can do some things. So much of what we talk about is fintech partnerships and how is this working. I think it's actually a little bit more nuanced. How and where do banks and fintech start to look at each other as potential dance partners, where an acquisition could be struck? Do you guys have any thoughts on that? Because I have thoughts if you don't. So don't make me talk.
I'll start briefly. On the fintech front, this is not my area of expertise. We do have a banker who's moved from our research department, and he covered Visa and Fiserv and so forth, and he's focusing on that segment. And he put together some interesting exhibits, and I thought they were really helpful. But really, he kind of bucketed the fintechs in three groups: the friends, which are the ones that are selling their technology and their capabilities to banks; the friend foes, which are kind of a hybrid. They're competing, but they're also selling to the banks. So you got that group, and then the outright foes. So they're just competing for your business. What fintech, has the ability to do is, focus on a niche and really dig in and drive revenue in that niche. And it can steal good customer bases from banks, but I don't think it's the core customer that a community bank needs. And so I think banks need to decide whether they want to compete for some of those businesses, those niches, and whether or not, how they're going to do it. Do they want to team up, partner up with these fintechs to do it? And then, but at the backdrop is the fundamental businesses, their C&I lending, middle market lending, that I just don't think the fintechs are going to be able to dig in and do the job that the community banks and regional banks can do.
Yeah, and I hear what you're saying. I guess I look at it a little bit different, well, not differently. I'm also not trying to structure deals or put companies together, but I think a lot of fintechs are really at their core just exceptional marketers. They know how to attract customers, and in a digital world where loyalty is fleeting, I look at some of these fintechs whose valuations and their funding rounds aren't so prohibitive for a bank to say, I should be doing something more compelling with them. We saw a credit union, the Navy Federal was buying some agencies, digital and marketing agencies a few years ago, because they knew that they needed the talent. They also needed the cultural shift. And so, some of the deals that are done or could be done may not always have the financial drive behind them. It could be to change the culture, bring in new talent, create a succession plan if one doesn't exist. Again, I'm trying to intentionally be a bit provocative as I put this in front of you guys, because I think that whole dynamic of banks and fintechs working together, competing against each other, at some point, I would think there might be some more M&A activity between the two, because you certainly see fintechs buying fintechs and fintechs, thinking about how they can be more of a bank, through an application into the federal government. So, I don't know, Gary.
I think
Go ahead. Yeah, go.
I was going to say, you just saw out, right? Ameris just bought Balboa Capital out in California, which was a point of sale lender, online lender. So that was a large transaction. Also a way to deploy capital, right? It was all cash deal. So, I think perhaps the pandemic fast forwarded us a little bit on looking at fintech again. At one point, an ATM was fintech, right? It's something that banks have been evolving and using technology for a long time now. So I think what we're seeing, I guess some of the conversations with even the smaller banks that I'm having is we need to learn more about fintech. We want to know more about fintech. I think obviously the ABA and the ICBA both have fintech, groups. Al, you've been having it be acquired for a long time. And up in New York, I've been to your conferences. it's here to stay, right? So I think what I'm seeing is a lot of smaller banks saying, we've got to get more educated. One thing we've done is, introduce them. Is it the Live Oak guys or the Canopy or the Total Technology Venture guys in Atlanta who work with a lot of fintechs. One thing I would say, both those funds are former bankers, and they like fintechs that work and help facilitate that partnership between banks and fintechs. I'm also seeing some banks do that direct investment. Obviously, as Jim mentioned, there's a lot of these funds that are popping up, but there's some of the older ones that if you're able to invest a little bit, you become an LP, and you really are able to sort of explore that. And I'm also seeing some of the banks, is it an MVB or others who, have professionals on staff who vet this for them. They vet fintech opportunities. They vet investments, even direct investments. And then lastly, I'm seeing some of the smaller banks just say, listen, let's use some of these guys who can help us with our API. And we got an open banking sort of platform. If we see a fintech that we like, we can move quickly. And again, it's not the end all be all, but I think you're seeing the smaller banks even are saying, we got to move in this direction. And to Jim's point, they could be friend, maybe your foe, but a lot of these banks, a lot of these fintechs, as you well know, Al, they really want to work with banks, and they love working with the banks. They love their expertise on the compliance side, their expertise on, lending and et cetera. So I think it's here to stay. I mean, all you got to do is pull up FD Partners, Q3 numbers of transactions and billions of dollars going in this industry. It's almost like the airline industries and others that were revolutionized by technology. The financial service, it's in the crosshairs for sure.
Yeah. And, I just want to echo, you were talking about Canopy and TTV. I think TTV is a really interesting one to look at if you're interested in the payments ecosystem and how it continues to evolve. That's not about M&A. That's just like a little data point of there are folks who've been investing who are, kind of front and center. And Atlanta, for this country at least, is really the hub of the payments world. So it would behoove bankers who are thinking, what do I need to learn more about, to realize those are resources that are pretty easily available. I mean, a quick Google search, you're going to find it. You're going to read what they're thinking about, and you're going to probably find some overlap of what you do with what they are. So I totally on board with that. Jim, I think you wanted to say something.
I think I just hit my earpiece by accident.
Oh, well,
Charlie.
I was just going to chime in, and I think there will be a lot of partnering, especially the smaller banks and fintechs. I think when you get into the M&A realm, the fintechs are very good at acquiring customers and marketing. They can do that effectively and cheaply. The banks have the advantage of low-cost funding, so a lot of them would like to pair up. But if a bank is looking to sell to a fintech, it depends. Are there regulatory approval issues? It might be an all-cash deal because you don't want their stock. It's complicated. Every situation's different, but there will certainly be more of it. And you'd ignore it at your own peril. Again, love the line about ATMs being fintech. You look at Rocket Mortgage; they've been around for quite a while now. It's a huge company, right? So they've been nibbling away at banks for a long time.
Yeah.
Here to stay.
I mean, look. Unfortunately, fintech is one of those overused terms where FIS is a fintech, but FIS is a Fortune 500 global behemoth.
Right.
It's not the same as the 20 guys that started an online account opening platform.
Right.
All right, so guys, we've got only a minute or two left, and I want to just do a rapid fire. We've got all this regulatory, shifting taking place, some uncertainty as to what's going to happen when it comes to deals. Certainly, reading about what's happening in the FDIC over the last few days is, just another example of living in DC why, politics should not be talked about on webinars like this. This year we saw a lot of deal activity. First 3 quarters, is on historic run. What do you each think we're going to find in terms of announced and finalized deals in 2022? Charlie?
Well,
Oh, Jim, your earpiece is working, so you get to go first then.
My earpiece is working now. I think, as you noted, some of the recent information coming out is concerning. I think you've seen some bigger deals that have gotten held up. They've been slowed down. I think a lot of the deals that the three of us have been working on have been getting through without problems, which is great. And it's really the bigger deals where the problems and the slowdown is occurring. But it's something to watch, and I'm sure that activity levels at those larger institutions and those larger deals are going to be driven a lot by whether or not people think those deals can get through.
Yeah. Mm-hmm. Gary, your take on next year?
Yeah, I think we, since I guess it's 2012 to right before the pandemic, 19, we were doing 250 deals a year, right? Plus or minus 20, 4 or 5% of the population of banks. I think we were just over 100 in 2020. This year, I think we'll do 160, 170. So I can see us getting over, again, if valuations improve and we don't have a huge credit deterioration, I could see it being back over 200 again.
All right. Want to
And
take us home?
I think along the same lines, we've seen, in quote normal years, 4 to 5% of the charters, choosing to exit. But that does mean 95% of the banks are choosing to re-up for another year, and we think that'll continue. There's no need for a rush to the exits. The bigger banks probably will be more susceptible to some of those regulatory challenges. Interestingly, I think coming out of the Great Recession, when the CFPB was, some were real headaches, some were perceived headaches. I mean, there could be some point where, additional regulatory trickle down could cause some of the smaller banks to decide to team up with somebody a little bit bigger. But certainly a healthy environment based on the market, based on multiples, et cetera, but no rush to the exits.
Well, Jim, Gary, Charlie, I appreciate each of you taking the past hour to share your thoughts and perspectives with all of us. We'll look forward to seeing you out at the JW Marriott Phoenix Desert Ridge. As a reminder, Acquire Be Acquired takes place January 30th through February 1st, 2022, which is how many days away? Getting close. So, fellas, thanks again on behalf of the whole Bank Director team. Thanks to everyone who tuned in, and hope to see you again soon. Thanks.
Thank you.
Thanks, Al.
Thanks, everyone.